Welcome, everyone. We're back, Kevin and I, another Financial 15, the show. We try to provide some financial knowledge, hopefully can improve your situation. We do all that in 15 minutes or less. Very efficient. And today we're going to TFSA's, tax-free savings accounts. We've talked about mistakes in the past. Another video, 5 new pitfalls you want to avoid with your TFSA. You definitely want to stick around.
Yes, we had a ton of questions about the two most popular tax sheltered accounts. There's RSPs and TFSAs. Today, we want to deal with TFSAs, pitfalls to avoid so that you can make the most out of your TFSA going forward. Now, if you want to see this video or any of the other ones we've done on TFSAs or RSPs, please go to our YouTube channel and subscribe. Great content there. You will enjoy everything that you see. Also, you can like us on Facebook, and most importantly, please go to our website at beckerorr.com. You will get this content, you will get blogs, you will get events that are coming up, a lot of information that can help you with your financial situation going forward. But today, we are dealing with the TFSA and pitfalls that you need to avoid so that things can work out properly for you and you don't have to worry about any of the odds and ends that may not help your TFSA. Clint, what do we want to start off with as the first pitfall that we should really avoid so that we don't have to worry about having any problems?
Yeah, we've done a couple videos on this topic here, specifically checking the CRA My Account too early. There's a whole system involved with how does the government know how much you've put into the TFSA. It does not get updated in real time. You don't add the money on Tuesday and suddenly the government knows about it on Wednesday and everything's up to date. Not the case. You have to appreciate there's going to be a lag. So if you check the CRA My Account, you log in and it tells you have 6,000 TFSA room. Depending on when you check it, you may or may not actually have that much room, because things may have changed, right? So we have to keep that in mind. We have a whole video on this topic. A quick recap here, Kevin. Financial institutions, banks, credit unions, brokerages, they give a record to CRA, often just once a year, and they do it at the end of February. So the end of February 2022, they'll give CRA the data for 2021. Yes. And then CRA will take some time to actually update their system. Often that's measured in months. So if you check in January of 2022, the 2021 data probably won't even be in the system. So it'll tell you have a certain amount of room, but it won't account for any contributions you may have done in 2021 because it's not up to date. And that could throw you off. Maybe you put too much in, you end up with a penalty. In fact, there have been court cases on that very subject, and it got ruled in favor of CRA, and the person had to pay the penalty. So you definitely want to be aware of this, right, Kevin?
Yeah, that's a big factor. I mean, a lot of people obviously think that, you know, the year ends on December 31st, January 1, I can go in, everything's updated and right to the moment. Well, no, it's not. I mean, they have to calculate everything that's gone on. They wait for the information to come from the financial institutions. That's why we say end of February at the earliest is when you should even check these. Even if you're looking at the end of March, maybe it's going to give you a better idea. If you know and have kept track, you're probably okay. But again, just based on what CRA's account says, don't automatically trust that in the beginning of the year, because last thing you want to do is over contribute. Again, as it has with the RSP, you get charged 1% a month, and you may not find out for a year or so beforehand, and that can add up substantially to what you'd have to pay in a penalty.
So very true. You don't want to check too early. Often we tell folks spring, maybe April, May. By then it should be up to date, and your My CRA account should have all the prior year contributions worked in. But that was the first pitfall you want to avoid. Yes. Another one you want to avoid, kind of related subject matter here, but if you have multiple institutions with TFSAs, you better have good bookkeeping, because if you're doing withdrawals and contributions across all these different companies, and you're allowed to do that, but it can get tricky because you still have the same TFSA limit. So you put 6,000 over here, then you take some out and you put 5,000 over there. Well, it all has to add up under the same contribution limit, and that can get a little tricky to handle. So you have to be aware of that pitfall. Otherwise, you could end up with a penalty.
Yeah, knowing the rules is the biggest factor. I mean, it's 6,000 total, no matter how many institutions you do. So you can't do 6,000 at one institution, 6 at another, 6 at another. It's 6 total. And the other thing is, you mentioned about the withdrawals. If you've taken the money out that year, it cannot go back in. So if you've maxed out your TFSA, if I take $3,000 out in June, I cannot put that $3,000 back in September if I come into it. It now has to wait to the new year. So again, it can get very confusing if you have it at a variety of multiple institutions. You have to keep track of this, because the government will at the end of the day. But again, if you've over contributed or taken too much out and then re-put in the same year, there are penalties, as we mentioned beforehand, and these are ones that you're going to have to pay. The government does not usually grant sort of the, oh, okay, well, we'll forgive you this time, is what's gone on. So keeping track of it at multiple institutions may be hard. It may be easier to do it at one, but again, these are things that are very, very important to be able to maintain having that
Yeah,
TFSA.
common pitfall we see. Common pitfall we see, right? You set it up, then you forget about it. Now you have a couple institutions, and you can end up over the limit. So a pitfall to avoid. Number 3 here. We'll move along. Boring to invest in a TFSA. So this is specific. We're getting kind of into the nitty-gritty rules around TFSAs. But in general, if I borrow money and I invest, now that's a risky strategy. First off, we got to acknowledge the risk. So if anyone does that, they have to be comfortable with that. But if I borrow to invest, the interest on my loan is tax deductible. However, if I put that money in a TFSA, Kevin, I borrow and then I put the money in a TFSA and I invest it within a TFSA, the interest on the loan no longer tax deductible. You lose the tax advantage of the whole strategy of borrowing to invest. So you got to be very cautious of that.
Yeah, I mean, that's the biggest factor. Everybody's got to remember that this is not a non-registered account. It is a registered account. There is tax sheltering going on, the same as an RSP, the same as a RIF. These all things are scenarios where you cannot deduct the interest that you're putting it in. So, I mean, if you borrowed money to put into a non-registered account to invest in stock, anything you're paying interest-wise, because that account is taxable at the end of the day, you can use that as a write-off. But putting it into your TFSA to do it, no, the government says you're putting money into a registered account. You cannot have the tax deduction going forward. So it is very important to remember that. Now, borrowing to put it in, you can do it if you're not worried about what the interest is and you're not worried about claiming it, depending on what you're earning in the TFSA compared to what the interest rate is. But again, if you're borrowing specifically to write off the interest, this will not work. The government's going to come back to you and say, sorry, we're not allowing that. You're going to have to pay.
Yeah, essentially, there's two tax advantages here, and the government says you get one of them. You can't deduct the interest and get the tax-free growth of the TFSA. You get one of the two. That's it. And another one related here, getting into the details of the TFSA. This was certainly an issue in my mind in 2020, 2021. We saw lots of people trading, aggressive trading with everything going on in the markets. But if you do that inside of a TFSA, too much day trading in a TFSA, you might lose the tax perks that come along with the TFSA. Now, there's no hard and fast rule. There's not a line in the sand be like, oh, if you have over 100 trades, it's really subjective. It's up to CRA. And they say if it's too aggressive, I wrote it down here, if it's high frequency or aggressive day trading, they'll qualify it as you carrying on a business, and then all the gains count as business income. Means the tax advantages of a TFSA are essentially lost. CRA takes them away, and you have to pay tax on any of your gains. So you have to be cautious of the strategy you use inside the TFSA.
Yeah, exactly. I mean, beforehand, people would day trade in their non-registered accounts and never had to worry about it because, anything that you gained or you lost, you had capital gains or deductions to write off, and there was always taxability there. Now the government's saying that, these same people, that this is how they make their living. If you're doing it in a TFSA, of course, you'd never, ever have to pay on that. So they're saying, well, hold on, it is a business. This was meant as a savings account going forward. It is not meant as your business. So you do have to pay taxes on it if you become too aggressive. And again, as Clint said, there's really no hard and fast rules. So, I mean, you have to be careful with what it is. If you're playing meme stocks or, the latest fashion that's going on, as you said, in 2020, 2021, you could be in trouble for this and the government can reassess and go from there. So just be careful of what you're doing and how your trading works in your TFSA, or you could get in trouble for making it a business.
Yeah, and again, high frequency aggressive day trading, there is no hard and fast rule of exactly what that means, but CRA's interpretation of that, and if they think you fit into that bucket, you might lose the tax-free status of the TFSA. So pitfall to avoid, that was number 4. Number 5 here, Kevin, we've said this before, and we'll probably have to say it a couple more times going forward. It's in the title. I get it. Tax-free savings account, but it's really not a savings account. You don't want to use it, in my mind, as a savings account. It's important to have savings as part of a financial plan. You need to have an emergency fund, just some cash on hand in case something comes up. Don't do that inside the TFSA. Put that in a regular savings account. Use your TFSA for investment purposes as part of a longer-term plan. Then you can get better growth on that tax-free dollar as opposed to just leaving it in a savings tool.
Yeah, and again, it is a misnomer. They should have called it a tax-free investment account, probably, to be safe. I don't know how many times the question has come up from people is, what is the percentage you're earning on your tax-free savings account? We don't have a percentage on it because you can put a variety of different things in. So if you go to the bank and they've given you 3%, you're probably in a GIC of some format or an interest rate that's being paid on that just as pure cash, but it is not a savings account, as it were. It's an investment account. So using it as an investment account is the way you want to do it. You do not want it as an emergency fund, and you just do not want to put it in there for, okay, I'm going to put my $6,000 in and just earn it at whatever the cost may be. It's more or less to try and tax shelter that going forward for you.
Yeah, so you have a limited amount of room in that TFSA. They cap it, right? So you have a limited amount of tax-free room. In my mind, you want to put that room to the best use you can. So if you use it for investments as part of a longer-term retirement plan, you'll get more tax-free growth than if you just use that room as part of a savings or an emergency fund. Emergency funds are important. You definitely need to have one, but just don't put that money in the TFSA. I'd say leave that money in just a regular savings account would be a better option there. We covered 5 quick pitfalls, Kevin. We did that in a rapid fire fashion. They're very efficient, but if we have more questions or you have more questions, get a hold of us, chatwithclintonkevin.com. You can see it at the bottom of the screen there. We'd love to hear from you. It's part of our website, little form, fill it in, and we'll get back to you as fast as we can. Anything you want to add, Kevin?
No, I think you covered it perfectly. 5 pitfalls have been done today. High level, quick. Talk to us if you need any more. That's all I have to say.
Take care.